Bajaj Auto sees profit booking after reporting a steady set of numbers in the fourth quarter. The company's profit and revenue see 6% uptick while margins remain flat. Management tells CNBC-TV18 that the 125 plus CC plus segment will outgrow the industry.
HJVN falls nearly 4% after posting its fourth quarter numbers. The company reports a net loss of around 127 crores, while the margins take a hit. The quarter four power generation falls by 4%.
Suzlon jumps nearly 10% as the company's reported a stellar performance of the fourth quarter. They reported a 73% uptick in revenue. Margins saw an expansion, and profits too rose multifold year on year. The management tells CNBC-TV18 they guide for 60% growth across key parameters in FY26.
And the loss expands for Ola Electric. On the back of an operationally weak quarter, the company's revenue falls 62% to around 611 crores. Kotak Institutional, they maintain a sell rating with the target price of 30 rupees.
Another earnings buzzer, Mazagon Dock falls nearly 5.5% after a sharp decline in profitability, impacted by significantly higher expenses and a margin contraction.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam. And the markets, well, they're giving back what we put on in the final hour of trade yesterday. It was an expiry-related factor that propelled the markets higher. And normally we see on the next day of a new series, normally on the first day of a new series, that's the next day post-expiry, sometimes the markets realign themselves yet again. I think that's what's happening right now. And that's why the Nifty is down 80 points or thereabouts. The Nifty Bank is well a little bit softish. But from the broader markets, plenty of stocks moving around. Though if you look at the advanced decline ratio, well, that's back in favor of the declines, because from around 1,500 stocks that are advancing, now we have 1,500 stocks that are declining. Crisscross on the screen.
Crisscross on the screen, Nigel. I'm just looking at the Nifty Bank. The Nifty Bank is a slight outperformer in the sense that it hasn't fallen as much as the other frontline indices. And we have a couple of stocks like ICICI Bank doing well. We have HDFC Bank as well, which is holding on. So if there is a recovery in today's trading session after the alignment that we saw in the last hour of yesterday's trading session, then the first day of the series, the low, will be extremely crucial to track for the frontline index. Remember, we're sitting on 2,200 points worth gains over the last three series itself. But it's all about individual stocks, and the first one on our radar is Samhi Hotels. The company reported a strong set in the fourth quarter, marked by a big jump in the profitability. We do have Ashish Jakhanwala, who's the MD and CEO of Samhi Hotels. Ashish, it's been a regular feature on our channel because of the recent deal that you had with GIC as well, and that's reflected in the kind of stock price move that we've seen over the last month and a half. But let's speak strictly on numbers for now. For this year, you did about 18% revenue growth, that is FY25 that we're speaking about, margins at around 36%, and your RevPAR increased a fair amount as well. So as you see things at the start of this year, what are your targets for FY26 when it comes to revenues, EBITDA margins, and revenue per available room?
Thanks for having me on the show. So I think we've had a fantastic FY25. For FY26, the early indicators are fairly encouraging, both in terms of performance of the hotels, but also what we're seeing in terms of demand growth in the core markets. So we do expect to maintain a double-digit revenue growth. And of course, we have seen in our portfolio this strong operating leverage. So for instance, if we grow our revenues at 10%, we end up growing EBITDA at about 14-15%, So I do feel fairly confident about maintaining a double-digit revenue growth, and that's without considering the impact of new inventory that we'll end up launching in the middle of the year.
Okay, all right. Hi, Ashish. Good morning. Good to see you, Ben. As always, the street likes what they've seen in terms of your operational performance during the course of the year. What about the RevPAR? What should it look like in the coming year in comparison to FY25?
So, Nigel, I must say you're talking to an entrepreneur who has infinite optimism, but sometimes even my optimism is up for a surprise in markets like Bangalore and Hyderabad, where RevPAR growth has remained extremely robust. While we have always guided towards, let's say, a high single digits to early double digits total revenue growth for same set of hotels, what we've seen over the last few quarters is that our optimism has been beaten by the market, largely because the office space absorption remains extremely healthy. Airline growth continues month on month. So I think we should be able to maintain double-digit RevPAR growth for same set of hotels, really.
All right. So, that's about the same set of hotels that you're talking about. Double-digit growth organically in the revenue, RevPAR, as well as a faster growth on the EBITDA because of the operating leverage nature of the business. If you could give us a sense on, what's your operationalization target for this year? You have about 700 rooms which are in the pipeline. How many of them come on board in the next year? And from the rooms that have recently opened, properties that have recently opened, how much could that contribute to incremental revenue for the company?
So I think we've just launched two new Holiday Inn Express hotels, one in Greater Noida and one in Calcutta. We have added rooms to an existing hotel in Bangalore. I think for us, the meaningful addition really happens around middle of the year, middle of the fiscal year, when we add a significant inventory to our Sheraton Hyderabad asset and a market which is really outperforming. And then we also add inventory to our Hyatt Regency in Pune, again, a fairly strong market. So that's really for FY26 that you'll see stabilization impact of the two Holiday Inn Express hotels that have just opened, and the impact of the addition of inventory in Sheraton and Hyatt Regency Pune. FY27 is a big year for us because we feel fairly confident to launch the W in Hyderabad. So that would obviously create a significant impact for our business. And a year after that, we have the rebranding of the Tribute in Bangalore, which is then going to be followed by opening of the Westin there. So we have a very robust pipeline starting middle of this year till almost continuing till FY28, FY29. And that's really without accounting for any new M&A or leases that we may acquire over the course of the period then.
All right. Ashish, if I look at your mix, the upper scale as well as the mid-scale, upper mid-scale, that's at around 40% apiece. How do you see the revenue mix shape up in the coming year as well as going ahead? What's your targeted mix? And also give us a sense about, GIC and you all did that deal with, with regard to that investment. For those hotels where GIC has invested in, what kind of a growth outlook are you looking at out there?
So Nigel, I think given the commitments we've made last year, which is for the W Hyderabad, the Westin and the Tribute in Bangalore, just mathematically, we see the share of upscale going up from, let's say, mid-40s to about 65%. Our upscale inventory is almost stated to be doubling over the next 3 to 4 years, going from about 1,000 rooms to 2,000 rooms. And that's, I think, pretty significant because currently our upscale trades at almost 2x of our portfolio RevPAR or revenue available per room, whichever way you look at it, right? So we would see a shift in the short term of our greater contribution from upscale hotels over the next 2-3 years. In the long term, I think we continue to see tremendous opportunities in the mid-scale segment. But today we don't have a very active pipeline, which is under development. The pipeline is all for what we can acquire in future. So I think in the short term, you'll see the 45% grow to about 65% in terms of upscale contribution. As far as GIC's joint venture, we have two fabulous markets in that joint venture, Bangalore and Pune. Bangalore continues to grow probably at the highest rate in terms of RevPAR across all Indian markets. And we do expect that hotel to continue to outperform. I think the big upside for that joint venture comes as we operationalize the Tribute in Bangalore and then open the Westin in Bangalore. Let's not forget that combined, it's about 360 rooms in a very strong market. And given current performance levels, it's almost about 90 to 100 crores incremental EBITDA from just those two hotels. And then, of course, Hyatt Regency Pune, whereas, we're adding more inventory this year, we'll redo some of the food and beverage over the course of the next 12 months to 18 months. So I think that joint venture, just the seed assets, I'm not talking about what we can acquire collectively in future, but just the 3 seed assets are extremely well poised for growth in the next few years.
I think the reason why Nigel asked you this question, Ashish, is because the last time you joined us on the day of this deal, you said that this portfolio could be about $300 million. Where does this portfolio stand at right now? And what's the glide path through the $300 million?
So I think, Mangalam, we have over the last 14 years built the business on M&A. And of the last few years, also some of the long-term variable leases. I think the fact that we have completely, strengthened our balance sheet, we have strong cash flows coming through the business now. We are jointly looking at some M&A opportunities, some acquisition opportunities, following the textbook that we follow, the underperforming, undermanaged hotels, which can see a turnaround through product, brand, operational management. So we believe between us and GIC that we should be able to secure some incremental opportunities over the next few quarters, and that will allow us to deploy the intended capital that we want to.
And speaking about capital, any immediate need for any other investment? I mean, we understand that you might be in talks with other private equity players as well.
Not really. Not at all, actually.
Not in the near future, right?
Not at all. I mean, there are a few things I can say with conviction. This is one of them.
We just bowled a googly there, and you you did a well left out on that one.
No, I think he's denying it.
You're denying it, is it?
Absolutely denying it. I'm saying there are a few things I can say with conviction.
Yeah.
And this no is with a firm conviction.
All right, not leaving it. Actually, a solid defense out there. Thanks a lot, Ashish, for joining in and giving us those details. You're sounding very, very optimistic, but we'll hold you to some of these numbers and wish you all the best for FY26.
Thank you so much, Nigel.
Well, for the time being, we slip into a short break. On the other side, we'll continue to focus on markets, which have now moved to the low point of the day. We'll also focus on a couple of stocks. Stay with us.
Welcome back. At the low point of the day for the market, just keep an eye out on Reliance Industries. That opened fairly well and now currently has moved to the low point of trade. So, causing a bit of a downtick on the frontline index. And then we have a couple of these IT names as well, LTI, Mindtree, and the IT index on the whole comes up for you. That is too putting a wee bit of pressure on the overall health of the market right now. But then nothing really to worry. It's still 24,750 for the Nifty. Jay Thakkar joins in for a quick technical check. Jay, your call on the index levels and individual stocks?
Hi, good morning to you, Mangalam and Nigel. Well, as far as the Nifty is concerned, I think that, it's been quite long now that, the index is now stuck in a range. Both the frontline indices, may it be Bank Nifty or Nifty. I mean, Bank Nifty is unable to surpass 56,000 levels on the upside. Whatever move yesterday we saw, Mangalam, in the last 30 to 45 minutes was mainly due to the expiry. I mean, we saw Nifty bouncing back from 24,750 to almost 24,900 levels, almost on the spot. But I think that still we don't have a breakout beyond 25,100. On the lower side, 24,450, 400 is a crucial support. So that's 600-700 points range within which Nifty is stuck. And even if it breaks the range below, I think that it has got a good support around the levels of 24,000, wherein it could fill the gap as well. So broadly, the range would be of 1,100 points. But then Bank Nifty has a 56,000 clear resistance. If it manages to take off those levels and that, like that, Fin Nifty manages to take off 27,000 levels, you can have a good financial, move from the BFSI, which would help Nifty to eventually break out and inch towards 25,500. But then till we don't have a breakout in hands, I would say that trading through options by, doing a long strangle, Mangalam, rather buying call and put both as a short-term trading opportunity would be better. As compared to the plain vanilla option, plain vanilla position in the futures, either on the long or short, because we don't have a breakout as of now on a very clear side. Although FI position is 20% long only, but then we have seen the short rollover mainly happening on the index side, and hence I would be a bit skeptical. And until these higher levels are not taken off, I would be saying that rather do long strangle instead of going plain long on the index. As far as stock ideas are concerned, I would say that SBI Cards, to my mind, looks really good from these levels. I mean, it has provided a breakout technically from a symmetrical triangle pattern. Also, from the derivatives point of view, we have been seeing continuously long build-up in this stock. So both from technicals and derivatives point of view, SBI Cards for a target of 960 in the short term with a stop loss of 895. This stock can be bought. And the second buy recommendation, Mangalam, would be on Jindal Steel. I mean, we have seen good rollers happening here as well. The stock has been consolidating, within a band of say 965, 945. But eventually, I think that the breakout is likely to happen on the upside. Today's dip should be utilized as a buying opportunity. One can keep a stop loss of 940 and target 980 to 1,000 at least in the short term.
Okay, all right, Jay, we've got your picks. Want to wind this down since it's a Friday with a dance step?
Definitely, but post-market hours, Nigel.
No, I think you can do it right now as well, Jay. Come on, you give us that, the 1-2 ka 4 step that you keep doing.
When the breakout comes in, definitely.
Thanks, Jay, for joining in, being such a sport, giving us your view on the Nifty, the stocks, as well as the 1-2 ka 4 step. Well, let's shift focus then to our special segment. We get a few ideas for profit from Money Control Pro. Neha joins us to help us out with the stock that she's tracking. Neha?
Today's stock idea is DCB Bank, which has rallied more than 35% in the past 3 months. However, there is more steam left in the stock going by the earnings performance of the bank in FY25 and the current valuation, which is the real draw. DCB Bank posted a good set of numbers in FY25 with net profit rising by 15% YOY on the back of healthy loan growth, robust fee income and contained credit cost, partially offset by a fall in the margins and elevated operating expenses. The bank's asset quality improved further with the fall in gross and the net NPA ratio. The slippage ratio has come down to the lowest in the past 5 quarters. Overall, the bank delivered return on asset of 0.9% in FY25, which is modest. However, there are levers for improvement in earnings going forward. In terms of margins, it can come under pressure due to further potential rate cut by RBI. Credit cost is already at a lower level. However, bank's operating expenses are on a higher side as it invested for growth in the past. As the balance sheet expands, operating leverage will help reduce cost-to-income ratio over the next 4 to 5 quarters. Overall, ROA improvement in FY26 can be driven by better operating efficiency, while margin and asset quality may remain stable and range-bound. In terms of valuation, the bank is currently trading at around 0.7 times book value estimated for FY27, which is very compelling. The valuation can inch closer to one-time book value, which can result in a meaningful stock upside in near to medium term.
Thanks, Neha. Well, time to slip into a short break. We'll get you more on the markets as well as on stock-specific action on the other side. Stay tuned. Welcome back. You're tuned into Chartbusters. Well, let's take a break from the equity markets. Let's focus on the commodity markets. Manisha joins us to help us out with the commodity space. Manisha, take it away.
Well, thank you for that. I'm talking about copper right now because while we're looking at prices coming off their 1-month highs, but for the month of May, it still is a very positive closing. So if you look at the LME markets, we are up by 5% for the month of May. And for this year, until time, copper has gained up by nearly 16%. It clearly is the best performing commodity within the base metal sector. And there are various reasons for the reason that the prices have continued to gain up there. But starting with the reasons that you have seen prices decline first. Well, first, it is about the risk of slower demand, the kind of data that we have seen from US, all of that has been on the weaker side. So whether it has been about jobless claims, which has seen an increase more than what the street was anticipating, and the continuing jobless claims are at almost multi-year highs there. The second thing that we were reacting to is the US GDP numbers. Well, it has seen a contraction for the first time in 3 years. Here as well, the street was anticipating. So the slowdown is something that seems to be hampering the price moves here. Having said that, other factors and fundamentals are quite supportive for copper prices there. The LME futures are trading in a backwardation that tells you that there is a tight supply in the near term rather than in the longer term. So tight supplies and immediate demand coming in has been supportive. Also, there have been reports of flood in mines in Congo, and that clearly comes in as a threat to global supply in case of copper there. The LME stocks have been on a constant decline as well. When you look at the numbers from mid-Feb, it has been a very sharp decline. The LME stocks right now are trading at a 1-year low. It has declined by 43% since mid-Feb and just about stands at 144,000 tons there. The street is also reacting to the IEA data, which tells you that going forward, the demand for copper is going to be quite strong. The spread between LME 3-month and cash also stands at $40 right now. And the IEA statement suggesting that the global demand will outstrip supply by 30% by 2035 tells you that a longer-term scenario for copper prices continues to be quite stronger there, especially when it comes to clean energy technologies, the AI data centers, and with the way we're moving on to EVs and renewables has been supportive as well. The final chart should tell you on what the outlook forecasts are when it comes to copper there. So we have BNP Paribas and Citi talking about $9,000 to $9,100 a ton. This is by the end of this year. 92.25 is what JP Morgan believes you will see in the third quarter of this year. Saxo Bank and Bank of America are talking slightly longer term. They believe that 8 to 18 months from now, you will be looking at copper at $10,000, even $12,000 a ton. So near term, slight weakness, but longer term, clearly a very strong case for bullishness.
All right, there's a forecast for copper, but does the same apply for Ola Electric? Turns out not, because it's trading sharply lower following a weak fourth quarter performance. Sudarshan joins in with more. Sudarshan.
It was an operational week for Ola Electric in Q4 FY25. Losses have expanded both on a sequential basis, also YOY. But outlook that company has given for Q1 FY26 is looking healthy. Now talking about the headline numbers, loss for Q4 FY25 was at rupees 870 crore. It has increased from rupees 416 crore that company had reported in Q4 of FY24. Revenue was down 62%. It has come at rupees 611 crore against almost rupees 1600 crore, and EBITDA loss was at rupees 700 crore versus loss of rupees 312 crore. Now coming to the outlook that company has given for Q1 of FY26. Company is saying that adjusted revenue growth on a sequential basis, Q1 FY26 versus Q4 FY25 is seen at 23 to 31%. Deliveries are seen rising 28%. Adjusted EBITDA margin may come at minus 10% against 78% that company has reported in Q4 FY25, and auto gross margin may come in at 28 to 30% against 19.2%. Also, commentary that company has given that in FY26, it's expecting to achieve break-even in auto segment, and gross margin, company is saying that it might improve to 35% Q2 FY26. But on the basis of earnings today, you are seeing a big downtick in the stock price.
Take that point, Sudarshan. Thanks a lot for that. On the basis of earnings, there is a sharp downtick on the stock price despite what the management had to say. Watch out for BHEL and CESC and IEX. A lot of these, companies are actually selling off right now at the low point of trade for BHEL and CESC. IEX as well is at the low point of trade, but a big move is what we're seeing on Muthoot Finance. So just keep an eye out on that one. Opened relatively flattish. Thereafter, there was a bit of a spike, and from there itself, it zoomed ahead up nearly 6.5%. Let's see what's causing that and whether this sustains here or not. And the other one I'm looking at from the frontline pack is Eternal. Post the liquidity event getting over, are the street watchers coming back to brass tacks? Maybe growth returns, a big cash is what we've seen, liquidity event, behind the company. Can we see some green here or not?
That's going to be the interesting one. They did a QIP after all at around 252 rupees. So, domestic money that was interested, looks like they are getting into that one. A couple of stocks though before we wrap up. Thomas Cook, you pull up the chart out there. That stock is spiking up. So good move is what you're seeing on Thomas Cook. Not just today, but all through the month, in the last 1 month or so. And also if you pull up Force Motors, that's the other one, bucking the trend. This week itself, big mover in the last 1 month as well. It's making fresh all-time highs. On that note, though, we'll wrap up on this edition of Chartbusters. Stay with us. Trading Hour comes up next.